Jeff Tumbarello, welcome to the Cape Coral Investor Network podcast, episode number 5. As you know, the market's constantly changing and investors are constantly looking at the best opportunity. So one of the reasons why I wanted to speak to you is that as the president of Real Cap Ventures, the president of Steelbridge Realty, and one of the founders of the Southwest Florida REIA, you have your thumb on the pulse of everything that's happening in the current market. Jeff, how are you doing today?
I'm good. How are you?
Doing good. As we know, there's typically about 4 phases in every market cycle. It's the recovery, the inspection, the hyper supply, and then the recession. With your analysis of the market, where would you say we are currently, and what signs are you looking for to determine the next cycle?
Well, we're in the top third of, I kind of call it differently. It's just really just a wave. One side's the seller side, the other side's the buyer side. We're definitely on the seller side of the wave right now. We're probably in the top half to the top third of that. I'm watching inventory and the cash percentage more than anything. And inventory, we're at 2.5 weeks. Peak season, we were at 2 weeks inventory. So you get a lot of people that just don't pay attention to the market, or they forget about, we are a seasonal and a cyclical market here in Southwest Florida. The market slowed down a little bit recently, but that's because it's off season now. And we're still looking at some months off season of over 2,000 sales, which is wow. That's a seasonal pace. We've been at a seasonal pace, I think, since last July. So there's a lot of interesting modalities in the market. So anybody who's trying to overlay the last cycle, you're probably going to delude yourself a little bit. Cash percentage this year is still somewhere between 42 and 44 each month. Cash percentage in 05 and 6 was about 5%. So it's definitely a different market. And then on top of that, factor in the macro picture of, $4 trillion monetary base, a $6 trillion Federal Reserve balance sheet. It's really hard to overlay the last cycle with the modalities of this cycle.
Right. And it's really difficult to watch the news because a lot of the headlines are misleading. So, for example, we'll start to see that the sales rate is declining. And a lot of that's due to a lack of inventory. Obviously, if there's less houses on the market, there's going to be less sales in the market. And the other part is that there's a major seasonal component, which you highlighted, where buyers tend to start to look at purchasing earlier in the year than when sellers are typically ready. So buyers are usually chomping at the bit in March, April, that early, that type of spring season. And really, sellers are getting their homes ready around that same time period, but they don't officially put their houses on the market until later in May. Jeff, I was curious, why do you look at the cash purchases?
Well, it's hard to have a bubble when 44% of the sales are cash, and particularly even if it was a bubble fueled by equity corrects really quick, kind of like a stock. While there's margin and all that in the stock market, for the most part, when it corrects pretty quick. I mean, I woke up this morning and my Carnival stock had taken a dip, so I bought some more. So, but that's when you're looking at, I've got to get to that 100 shares so I can get my $50 room credit when we finally go on a cruise ship again. But you're looking at, and go back to touch what you said about the media. The only numbers that truly matter are year over year, and the media will talk about month over month, okay, the June sales are down from May. That's just valid every year since the beginning of time with our seasonality in Southwest Florida, because you've got the snowbird season, which is really December through May. And then in the summer is when the locals do this. Plus, you've got investor activity the whole time. If you're a local, you're not really trying to buy a house December through May because, first of all, it's too busy and you're too busy. The exciting part, particularly say for commercial real estates, and say you've got a property and you're looking for a local to rent it, you at the end of, say, May, all the locals have the most money they're going to have for the whole year. So there's a lot of really interesting things in the seasonality, but the media really and truly have no idea about what they discuss. and more it's just hype. I had people messaging me about the storm that just went through, that they thought that like it was terrible here. And I'm like, I'm drinking, I've got whiskey on the rocks on the dock right now. It's definitely not that bad. You know, we live on the water, and the water didn't even get as high as it had a couple weeks ago on just a random day. But if you get on the news, it looked like everything was terrible. But it's all hype. You know, if it bleeds, it leads.
Right. I actually had a couple of showings the same day as the storm, and we just brought an umbrella. that was the main difference. Now you and I both know that housing data tends to be a lagging indicator of the economy overall. Between a buyer making a decision to purchase a home, to going through the mortgage applications, to going out looking for the property, to actually getting a property under contract, all the way through finally closing. So sometimes looking at the actual sales and closing data can be, really 3 months behind the actual original signal. Reed, what are some of the early indicators that you use to look at to see how the market will perform in the future?
When the lockdown happened here, I started focusing more on the pending than anything else. I still watch the closed because there's more data points. There's really a lot more valid data points in the close. Like, you really don't know exporting from the MLS if it's cash or not, or you just know the list price and what area. But I watch the actives and the pendings. That's what I call the forward-looking numbers. So you can really, pending is a pretty recent act. So somebody wrote a contract. It's still got to come to fruition. A closed sale, like you just said, is an act that started 30 to 60 days ago. So that, if you're focused only on the closed sales, you're likely to miss some important data points. But during the downturn, I had just read a book about business cycles, and the guy who wrote the book talked about forward-looking metrics, as he called it. So I sat down and I'm like, what forward-looking metrics in real estate? The best ones I could find was Showing Time publishes the showing requests numbers. I mean, you have listings, then you have showings, then you have contracts, then you have closings. So, if all of a sudden inventory starts cranking up and the pendings go down, that tells you to start evaluating your model. Like, we buy and sell a lot of lots. Personally, right now, I'm risk on. I'm not afraid to take risk. So if all of a sudden inventory started cranking up, I would probably go to risk off. And I'm still going to do business. I'm just going to do business with a little less exposure.
All right, that makes a lot of sense. And there are a lot of investors who are anticipating a crash as if it's imminent. But what they fail to realize oftentimes is that we might see a recovery in a growth stage be 18 and a half years. There's actually a rule called the 18-year rule. And then really you just have a short window of maybe 3 to 4 years of an actual downward pressure housing market. What are some of the downsides of waiting for a housing crash?
Well, it's a very personal decision to make that decision. And so what you or I say, somebody should consult their tax person, somebody should consult their financial advisor, because everybody's situation is different. Now, to sit on your hands and not make money waiting for the next crash, I don't understand that, because you've got a wonderful trend line that you can work from, the bottom to the peak. And then at some point, there's what I call the falling knife part of the cycle, which, once the market truly starts correcting, a lot of the smart investors pull back to wait and see where it goes. And that, again, forward-looking numbers will tell you. The last cycle, we were really dead on tracking it and predicting it. And in March of 2008, our year-over-year sales counts turned up. And at that point, okay, I'm not saying at that point it was time to go completely risk on and go big. In hindsight, it absolutely was. But, you're never really a parent, because hindsight's 20/20. But I still see enough perma bears. I call them, there's perma bears and perma bulls. There's some people that no matter what, it's a great time to buy a house. We all know that realtor in the middle of 07 and the correction, it's best time to buy a house ever. A lot of trade groups do that too. But you also have people we have them at the Southwest Florida REIA, that they're just perma bears. Market's going to blow up any day. And the last cycle, by late 05, even the perma bears were questioning their very essence of their soul of being, you know, a bear on everything. And honestly, I think at the point when the perma bears start to become converted, that's just the absolute peak of the cycle. So, because a lot of this is a mentality, it's really hurting in a mentality more than anything else. And then factor in, you know, the macro picture is definitely different than before. You have a huge flight of capital to here and to Texas from what I call the occupant favoring states. You know, the Bruce Norris had an amazing, you know, he talked about when he spoke at the REIA, does a state favor the occupant, the owner, or is it neutral? I kind of feel like Florida's a little neutral, you know, but at least you can evict somebody at some point in the state of Florida. There's some states like, say, California, particularly the urban areas, that you really don't have rights to your property anymore. And so you've got that flight of capital that's completely changed this cycle. And then something Boris brought up at the Southwest Florida REIA, we're not even feeling Europe or Canada yet because they can't really get out yet. So there's still some capital going to come from there. So anybody that's claiming to know this cycle is probably deluding themselves.
Yeah. And I often feel like talking to investors who are thinking about waiting for a crash is that they over romanticize how great a crash is. And so people often forget is that in 2010, when we had the big bank bailouts, they weren't lending the money. so it wasn't as if capital was readily available. And there was a lot of talk in the media of a double dip recession. So there wasn't even a certainty of where the bottom was.
Remember the second wave in 2012 that was going to take out everything and you ain't seen nothing yet? And my favorite was at a REIA meeting. Some realtor was commenting about how there was 2 million properties about to be released in Lee County from Bank America. And I'm like, the tax roll is 650,000 lines deep in Excel. You know, and you know, there's plenty of people that are stable and didn't buy into the last thing. So some, you know, the misinformation's huge. What's important to you is what you can prove for you, for your own use with an intelligent plan. The biggest thing for investors is you got to really have that "what am I here to do" talk. And so many investors are looking for a deal. They're looking for this, they're looking for that, but they really don't know what they're there to do. They don't have a framework. They don't have a value system. Like for me, I've got very specific models that I'll deploy capital if I'm going to get X. So 100% I know what I'm doing, and I'm making a numbers-based decision, not wheeling and dealing. We all know the people that basically lowball stuff, and as long as at a percentage of list price, they feel like they got a deal. You know, and sometimes you can get trapped. Something will be listed for 10 that's worth 5. You think you got a deal because you got it for 4,500, but there's really no margin in there if you're planning on reselling. So, you know, it's really important to know what you're there to do. And so many investors, they get caught up in the hype, and then you go down the whole YouTube, which we're going to be on, but you go down the whole, this guy's a millionaire because of this, that, and this. And, you know, it's really about having a system, particularly putting what I call a value on your money. You know, for me to deploy capital, I need X percentage, and it's a personal decision of, and if you can set that model in your mind, you'll be fine. If you don't set that model in your mind, every once in a while, you're going to step on something you shouldn't have.
Right. And I'm a big fan of understanding why you made a certain decision. Because for me, one of the biggest missed opportunities that younger or newer investors have is wanting to go for a grand slam with nobody on base. Sometimes you just need that single. You just need to get on base, have a small victory, and start that learning curve, because there's a big difference between sitting on the sidelines watching a game take place versus when you're actually on first base and you're making decisions about whether or not to steal, whether, you know, where the ball should be placed, etc. And so I always advocate for understanding, like you mentioned, what you're there to accomplish, and figure out, how do you get on first base? What's that first step? Where does that first action take place?
I had a guy in 2008 that was a referral from a local home builder, and said, you know, at this time we were the only people in town with a functioning foreclosure database. So I was quite the media darling. And it was really interesting time. I mean, I was even on Bloomberg TV at one point. But we're sitting down, and the guy had about $1.4 million to put in the market. And I finally looked at him in the conference room. We'd looked at some houses and we kept talking. And I'm like, at some point you just got to do one, and in the middle of, after you do one, what's the worst case scenario? You have one rental with a property manager if you decide it's not for you. And in the middle of doing one, he got addicted, and we ended up, I think, doing 29 for that particular investor. So, but yeah, and and if you're not playing the game, randomness comes in both directions. Sometimes it's bad, sometimes it's really good. I'm one of the owners of a company that we're actually shutting down, Florida Land Team. We did about 300 plus deals in the last probably 14 months, and we had a 5-lot package under contract for 2 buildable N2 lots, which are the utilities. And we had 3 freshwater lots, which at the time were just not viable lots. Nobody wanted them, but we weren't going to get hurt on them, but we were basically going to list them just to get the other 2 lots. We were going to buy them and then, list them and just break even, and we'd have been fine because the other 2 lots were really high profit lots for us. Well, in the process, there was a slight title issue. So in the process of getting the title issue fixed, suddenly the market decided they liked freshwater lots. And we ended up making a lot of money on those 3 lots, more money than we did on the 2 buildable, the 2 N2 builder lots. But had we not been in the game and not playing the game, we wouldn't have been able to capture what I call that positive randomness. So you're 100% right. If you're not in the game, it's really hard to get maybe you get lucky and the guy drops a ball and you get a triple out of that single if you never go to bat. A good baseball analogy.
There's a lot of discussion about comparing our current cycle, our housing cycle, to what happened in 2018. But there's obviously a lot of differences. Specifically, there was a lot of supply at that time period compared to now. That we don't have the same subprime mortgage issue as we had back then. A lot of them, there was a lot of investors selling to other investors. So the idea of the greater fool theory definitely was in play then. And there seems to be currently versus last time, we're almost providing a lot of capital, a lot of cash available now, and unlimited stimulus at the moment. When you compare this cycle versus last cycle, what are some of the things that you're looking at?
Well, the cash percentage is big. This is primarily end users driving a lot of this especially this last 18 months. The investors coming in are generally 1031, very well-heeled too, intelligent. It's not your barber buying 5 houses with no money down, which was the case before. I owned a mortgage company in the last cycle, and I probably didn't see a W-2 for most of 04 and most of 05 because everything was stated income, stated asset, because the rates were even the same. What was the point of doing all that when, if they had the credit score and the LTVs really weren't any different. So from a lending perspective, most of the mortgages are still tied to wages, which is really a big deal. And then on top of that, we've already had a couple little mini corrections in this cycle. It's been very like 17 and 18. There's some months where pricing year over year dipped a little bit, a couple percent, not a lot, but inventory would crank up and then prices would go down a little bit. It's been normal supply and demand more than anything else. And right now this is just hyper demand, but it's real demand. It's not your barber buying 6 houses, or you'd go out to eat and your server would have just bought 4 new construction condos. That's not sustainable or normal. The gentleman who just sold a house out of San Francisco, 1031ing into 3 Northport properties, I think he put 30% down on the loans. He's got some holding power, even if the market corrects a little bit.
Yeah, we're also seeing inflation play a major role in our economy. Not only are buyers flush with cash, but there's also a lot of thought process of how to hedge against inflation. And a lot of people are looking at real estate as a way to do so. Jeff, is buying real estate investment a hedge against inflation?
If there is inflation. So, I mean, but see, I'm wired to be a value investor. I mean, I felt most at home in 2009, 10, and 11. That market to me made the most absolute sense. In an inflationary market, which it's kind of hard to say we're not going to be, low interest debt on a 30-year fixed rate is probably your greatest hedge against that. You look at the United States national debt, we're borrowing a lot of cheap dollars in 2008, 9, 10, 11, and we're now paying them back in severely inflated dollars. And the country's doing it. There's no reason for you not to do it if that's really where this ends up. But then in the back of my mind, I'm always like, why do they need to print all this money if they're not worried about deflation? So, but I mean, the amount of money, whenever something happens on the macro level at the Federal Reserve Bank, it's generally not felt on the streets for 9 to 12 months. So we're only feeling the effects really of the first stimulus. That second stimulus is what's really going to kick it in for inflation. And we're probably still 6 months from really feeling the net effects of that. If they do a big infrastructure spending bill and that really hits the streets, and if they do another stimulus, I would totally agree with that. But it's kind of hard to lose money borrowing. One of my mentors, I have a lot of equity in my home. And he asked me if I had done a mortgage, because my house I could take out a bunch of money on right now at 3.25 or something like that. And he's like, so I thought you were like, Mr. Guru. He goes, you mean you can't earn more than 3.5%? I go, why wouldn't you grab that? And part of me is wondering, because I'm actually leaning more towards paying it off. But, why take 300 grand at 3%? That's the cheapest private money you've ever seen in your life, providing you make prudent decisions with it. It's really a interesting quandary, because I want to get out of debt. I want to have no debt. And then I don't care what happens, because 2008, 9, and 10 really imprinted on me like everybody else that lived through it here.
Yeah, it's funny because I actually just refinanced a property that I bought last February, and I'm getting $115K out of that. And my mortgage is only going up $200. So, wow. so for me, well, I also had PMI payments on that, so it obviously removes that. For me, I think it also depends on where you are in your investment strategy. I'm still definitely in that aggressive growth stage where I want to be able to take advantage of all the future opportunities that may come into the market. Jeff, you recently started a new company called Real Cap Ventures. Can you talk to us a little bit about the new company and why you started it?
Well, we had one company called the Florida Land Team. There was 3 of us doing it. Partners just decided difference in opinion, difference in visions, kind of go our separate ways. Kind of excited about this because the last company was very specifically focused on land. We're hitting all the asset classes. I'm even looking at mobile homes, and we're not going to be selling them. I just plan on keeping them all. And I've done some deals where we become the bank on a cheaper mobile home for somebody and have some yields in the 20% a year range doing that. It's really, really an amazing investment. So we're chasing all the asset classes. The boat market's so hot. I'm thinking we may even start going after boats. I mean, who'd have known at this point last year, if you'd have bought every boat on Facebook Marketplace, in some cases you're up 30-40%. And, and as long as you didn't beat it up and take care of it. I mean, right now, and that's where I start to buy into the inflationary part, because everything is going up. It's not just real estate. It's not just cars. It's not just boat. It's pretty much everything. So yeah, we're chasing pretty much every asset class in about a 7-county area. And we're actually being asked to go after stuff in some other states to help some people basically to buy stuff. So it's a lot of fun. We've hired a bunch of people, and I think our first 3 weeks, we probably booked 21 transactions in our first 3 weeks.
Yeah, now there are a couple of different e-buyers or digital buyers out there in the marketplace. A lot of them look to resell the property and just hold the note until they can find another buyer for them. What's the advantage of being a private investment firm?
Well, you're a private investment firm. You're kind of I call it kind of a family shop more than anything, and we're just investing our own money and making our own decisions. And so you can make your own decisions. But the only problem about having a private investment firm is if you make a bad investment, well, it's your investment too. So you really got to make better decisions. But it's always a heightened sense of heightened sense when it's really your money on the line. You know, you really want to get all the due diligence. You drive by that lot, you climb under that mobile home, you know, you really get after it, which you should be doing. If you're a broker or a realtor, you should be doing that for everybody to do business with as well. But when it's your money and your company, it's definitely, you know, you don't want to have to eat ramen noodles for the next 6 months to recoup the bad choice you made.
Right. Well, Jeff, I do want to thank you for your time. The conversation goes so quickly. I wish we had more time. We'll definitely have to book you again in a few weeks or so, and definitely keep the conversation going. Jeff, if you want to tell the people how they can keep in touch with you, feel free to let them know.
Your best bet, particularly if you've got assets in the state of Florida, you'd like to sell, realcapventures.com. If you're interested in the Southwest Florida REIA, the Real Estate Investment Association, and that's been meeting since I think November of 2003 now. It's amazing. That's SWFL REIA.com. And then on the brokerage side, which you're a Steelbridge agent as well, just go to Steelbridge Realty LLC, or just click on any of Alvin's links and call him, and he can get in touch with me.
Jeff, thank you so much for your time. Have a good one.
Thanks, man.